Hello and welcome. You're watching KYC, which is Know Your Company. It's a brand new show on NDTV Profit. In this fast-paced world of stock markets, we are all, including investors, bombarded with information. But what we often lack is a deep and comprehensive understanding of specific companies and specific companies you invest in. We try to break each company down, right, to give the regular investor powerful, actionable insights into the fundamentals of single NSE listed company every day. So every day we do this, and this is of course a new show. Today we're going to zoom in on Royal Orchid Hotel. It's a sub-1,000 crore market cap company, but the hotels business in general has done very, very well through 2023 as well as 2024. This one was incorporated, as you can see, in 1986, and it was named Universal Resorts. Thereafter, it has now diversified. It also manages hotels under flagship brands, but it's largely also in the business of running hotels. So these are all the brands that they run as well as manage, and they currently have a portfolio of 109 plus hotels and resorts, and they boast 6,556 keys, and they are also ramping up fairly quickly in terms of expansion. Currently they are spread across 72 plus locations, and this is how their revenue split currently looks like. That's room revenue 57%, 34% coming from the food and beverages pocket. Then there is managed hotels, which is roughly 6.5% but growing fast, and then you have 2.5%, which is other services. That's the larger split with regard to how revenue stacks up. In terms of how operational metrics are stacking up, let's look at some of them. In terms of average room rent, both for the existing brands as well as for the managed brands. And before I do that, let's quickly look at the parameters. One is you have operational metrics that we will look for. We look at various metrics from average room rent to occupancy, and try and gauge as to how and what's the kind of pattern that's coming out from there. We look at the revenue, income statement, margins, as well as profit after tax, how the growth has been. We'll do a quick balance sheet check. We'll do a cash flow check as well. We'll look at return ratios. Capex heavy businesses, always we focus in on the return ratio. The shareholding pattern, how much is owned by promoters. We'll also see what kind of returns the stock has given, and we'll also zoom in on what kind of coverage the stock has. To break all of this down, I have with me Anushi Vakharia, who tracks hotels and who tracks hotels quite closely. Anushi, first on operational metrics. I was just, before you came in, just speaking about how operational metrics have panned out. Your average room rent is just marginally reduced, right, in FY24 versus H1 FY25 versus FY24. Give us perspective on what's happening there in your view.
Right, Harsh. So before we go to the income statement checks, it's very important to highlight some of the key operational measures that a hospitality business has. Three important figures if we have to see is obviously the occupancy levels, as that indicates how the hotel is performing, if there is demand scenario there or not. So average room rates, as you've mentioned, that in FY23 the rates were around 5,370 rupees, in FY24 5,673, and this has decreased to 5,141 rupees in this. But do note that a lot of the company's assets are under renovation and refurbishing, so it could be a result of that which we could be looking at, but definitely commentary on this would be awaited from the management side. This is from the joint ventures, leased and owned hotels that we are seeing. Even in the managed hotel piece of business, if we look at the ARRs, the average room rates have remained similarly in the 3,700 mark to 4,000 of mark. So further growth from these levels is something that we should definitely be watching out for. If we look at the occupancy levels, occupancy, what was at 77% in FY23 is now at 70% in H1 of FY25. Similarly, in the managed business also, last two fiscals we've seen a 60% of an occupancy level, and in FY23 this figure stood at about 63%. But with that, let's move to the income statement. If we look at the revenue picture in FY23, FY24, we've seen the 264 crore of revenue in FY23, and in FY24, 294 crore of revenues. Margins 31%, then which have decreased 26%, and we're looking at a 20% of a margin picture. But again, this is a result of two factors that we are seeing. One is increase in the cost. This translates to both the staff as well as wages and other renovation cost as well. Along with that, something that we should be pointing out is the change in the Indian accounting standards also, because of which we are looking at this change. Net profit, if we see, have seen about a 17 crore of a net profit, and in FY24, 17.7 crore of a net profit. In H1, this figure stood at about 16 crore. So a good growth in terms of net profit that we are seeing compared to the other metrics. But this is as well as the key operational metrics and the income statement check goes. But let's also talk about the balance sheet, Harsh. There's a lot of important space to cover there as well.
Yeah, absolutely. Because how is the company allocating capital? And let's look at, first off, shareholders' equity. It's a strong equity base for a sub 1,000 crore kind of company. So 200 crore in terms of equity shareholders funds. A large part, in fact 90% of this is profits which have been plowed back into the business. So just about 27 crore of pure play equity. The rest is all sitting in premium and reserves, and therefore looks fairly healthy. Look at the debt. That's really standing out for me. 84 crore of borrowing at the end of H1 FY25. No concern whatsoever, because it's a fairly healthy mix of debt and equity. In fact, debt is quite subdued to a large extent, and therefore this is looking fairly good in terms of how the balance sheet is stacking up. Let's look at the cash and bank balances. Well, 45 crore rupees of cash for a roughly 20 odd crore rupee profit business. Not bad at all, and compared to the debt as well, around 80 crore of debt. They've got a fairly healthy amount of cash which is sitting in books. So overall, it looks like a very, very healthy balance sheet, well placed for growth, good opportunity to increase debt to grow, good opportunity in terms of utilizing cash to grow. Working capital needs seem to be well taken care of, but that's how the balance sheet is stacking up. Let's look at the cash flow as well very quickly. Now, cash flow from operations has come off slightly, and that's obviously because what Anushi said, there's plenty of maintenance happening in H1 FY25. What's the pipeline like for H2 will be key to understand there. Your net cash flow, though, has improved to a certain extent. So in that sense, there's a bit of improvement. But that's how cash flows are stacking up. You give it an even Steven kind of a rating on the cash flow front. The dividend yield is 0.7%. Not expecting too much, because it's a strong return, or it's a company which gives strong return ratios, and therefore dividends can be depressed for some time because you're getting a 20% plus kind of ROC, which we will come to. Anushi, why don't you, or rather let's look at the return ratios while we are at it. There you go. So look at the ROEs and the ROCs, how they're stacking up. The ROC is roughly 18% currently. The ROE is sitting at a healthy 25%, and therefore a depressed kind of dividend yield, not too bad. Return ratios definitely deserve a thumbs up, because it's a 20% plus kind of return ratio business, or rather mid-teens to 20% kind of return ratios business, which is very solid for a hotels business. But Anushi, shareholding.
Harsh, no complaints there as well in terms of shareholding. If you are looking at promoters hold about 63.64% of the stake, while foreign institutions hold about 6.5% of stake. Coming to domestic institution, about 0.67% is what they have, and with the rest remaining stake is with the public, that is around 29% of mix. So a good mix in terms of shareholding that we are looking at. But let's also see how the company has performed with the kind of metrics, the balance sheet, the cash flow it has. How is the investor confidence in this company? In the last 6 months, we've not seen much of a movement in terms of stock price performance. We've in fact seen a 1% of a downtick. In 1 year, we've seen about 11% of an uptick in stock prices. But the last 5 years, it's the last 5 years which we've seen a very healthy number, around more than a 300% of gains in this company. So definitely in terms of the long-term perspective, the stock has awarded its return. While coming to the street coverage, we don't have a lot of analysts on the street covering this particular company. We just have one analyst, and their target price is around 431, which is again a 22% of an upside that we are looking at. So this is as far as the shareholding, the promoter confidence, the street performance, the investor, how they think about the company, and the analyst recommendation goes for Royal Orchid.
Okay, so that's how we're stacking up. Let's quickly summarize that in a nutshell first before we do a quick SWOT. There you go. Operational metrics flat. We did speak about this. H1 this year was slightly depressed. How quickly are we recovering in H2 is something that we'll have to look for. Income statement also flat because margins were slightly on the weaker side, even though profit growth was strong. Balance sheet looks very, very healthy. Cash flow, because of the income statement, largely impacted this time around and therefore flat. We'll have to wait and watch how that plays out. Let's quickly move to the next one. There you go. Return ratio is definitely a thumbs up, no doubt there. Shareholding, 63% has remained above 60 for a very long period of time and therefore clearly a thumbs up. Street cred, it's given good returns, especially in the medium term for sure. Street coverage, there's just lack of it, frankly, even though Nuvama has a very positive, constructive note on it, 22% upside. But that's how the KYC rating stacks up. It's a 5.5 on 8, a very healthy one. But that may change a little bit depending on our interaction with the management. Before I go to management, I want to quickly look at the strengths, weaknesses, opportunities, and threats. First off, on the strength side, it's got good brand presence. The room additions and the pipeline looks extremely strong. On the weaknesses, it's a smaller brand versus some of the bigger ones. Indian Hotels, East India Hotels, far, far stronger brands in that sense. And that's where it probably doesn't pack as much of a punch. Also on the size of the company, just 1,000 crore versus the kind of company size that some of the others are at. Margin pressures, temporary, likely, but at the moment, that's a weakness which is sitting in that box. Let's look at opportunities as well. There's a large growth runway, right, Anushi? The hotels business these days has a very large runway. Why don't you take this over?
Especially after COVID, what we've seen in terms of travel, the revenge travel that we're seeing, it's been crazy for hospitality.
You've been traveling quite a bit.
You too, Harsh. So if we look at the opportunity side of the business, there's a long growth way that we are looking in terms of revenue for the company. Anticipation is of a 15% of an increase in terms of revenue. This is from the existing brands itself that we are seeing. Another good opportunity for the business is that now instead of volume, it's considering on its value offering. So this means that its focus is shifting towards its more premium offerings, which is catered towards the 5-star business. So again, a good set of ARR growth that we can see coming in for the company. We had pointed out in the beginning as well that ARR pickup is something that we should be watching out for in terms of management commentary as far as it goes. There's a lot of capacity additions also happening in terms of new pipeline coming into the picture, which could further aid the revenue growth for the company as well. In threats, if you look at this is more on the operational side of, or more on the industry side of threats that we are looking at. Firstly, hospitality as a business is cyclical in nature. So any kind of disturbances in this is potentially what we can be seeing in coming. But after the kind of return that we've seen post-COVID, this is one industry wherein is cyclicity a question again still looms over that. And again, other than that, occupancy levels is something that we should continue to keep in check for some of the new properties coming in for the company, since this could be something that we should be watching out for. This as far as the opportunities and threats of the business are concerned, Harsh.
Right. While we are at that, let's also quickly go across. We have the management with us. We have Amit Jaiswal, who's the CFO at Royal Orchid Hotels, joining us. Welcome, Amit. Good having you here. Amit, I want to first start off by asking what's happening on the ARR front, which is average room rent. Or rather average room rates. What's happening there? Do you believe that this taper towards 5,000 in your hotels is something which is going to last in the medium term? Was the FY23 and 24 numbers slightly, in that sense, an anomaly?
Yeah, thank you so much.
Right.
Yes, let me tell you one thing. As far as the ARR growth is concerned, if I, compare the last year, same quarter or H1 with, this year's H1, there is a growth. Okay, so last year we were at around 4,700. Now we are at 5,100, and so. And let me tell you also, the ARR is going to grow substantially in next 2 years. That is 25, 26 and 26, 27, there will be a growth of roughly, 15 to 20% growth you will see in ARR because there's huge demand. Now, if this quarter is very good for the entire industry as such, it's not only raw locket, but for all the entire industry, the occupancies has been good and the business is good. And that's why it will drive the ARR to go further. The growth in demand in last couple of years has been phenomenal. Okay, the economy of our country is doing well. There's huge domestic travels which happen, but of course domestic travel affects the leisure destinations, but business also is doing well. And I have no reason to, estimate a growth of 15% in the ARR in next 2 years.
Jaiswal, this is Anushi joining in. So 15% is the growth projection that you have for the next 1 to 2 years in terms of ARR. So considering that along with increase in occupancies, if you can give us a picture on that as well, what is the kind of revenue growth that we can expect from the business side, since you have tall targets for the PAT margins and the PAT numbers as well for FY26 and 27? If you can help us with the revenue growth for the company.
Yeah, so as far as the occupancies are concerned, right now we are at 70 plus. So it may go up by another 5-6% because doing an occupancy above 77-78% becomes a little difficult. Being the weekends, the occupancies of all the business hotel drops. So I believe that the occupancy of 76-77% will be the optimum occupancies. So another growth of maybe 3-4% will be there. Now, as far as the year 25-26 is concerned, let me tell you that we will be launching our new 300-room 5-star deluxe hotel in Mumbai next to the Terminal 2, which we will be launching at the end of this financial year. So that the next year this hotel will add a lot of revenues to our group as such. 100 crore plus will be added. So next year our target top line of 500 crore is there. And the bottom line will grow by almost 20%. That's the target we have kept for next year, which looks very reasonably achievable.
One quick clarification on this one. So you will have a new hotel coming up in Mumbai next to T2, likely that will help your ARRs as well. Does this 15% bump up in ARR include that? Okay, yeah.
No.
Understood.
That is excluding. That will bump up our ARR drastically up. This I'm talking the organic growth will be around 15% next 2 years.
Understood. So this is on existing hotels. There will be a 15% growth. On top of it, you'll have your Mumbai hotel, which will contribute disproportionately with regard to the ARR. So understood, sir. Also, I want to understand how has recovery in H2 been? You had certain pockets of your business which were under maintenance. And therefore, there was some bit of anomaly which crept into H1's numbers. Has H2 been robust for you? Has it been full-fledged in terms, and I'm not asking you numbers, but just in terms of business, has it been full power?
See, yes, let me get back to you. I was just hearing both of you speaking about our company that our bottom line got hit. Okay, let me tell you, I have given a lot of explanation towards that. See, we all of a sudden, when the COVID started, we were around 40-45 hotels we were having. Then all of a sudden in last 2 years, we have crossed 100 hotels and our target is to, take further. We have around 21, 22 hotels in the pipeline signed, which are ready to open in next 6 months. So we had to invest a lot of money in creating the bandwidth and the infrastructure to manage such a large chain of hotels. Okay, that's why what happened in last 1 year, if you see, we have invested a lot of money into that, whether it is IT, manpower, and and a lot of hotels required some spruce up. So we have been investing. That is why our bottom line got hit in last 1.5 years. However, the benefit of this will come in next 3-4 years. Okay, whatever we are doing now, this expenditure are being hit into our P&L immediately, but the benefit of all this we will be reaping in next 3-4 years. So that is why I am telling that, you know, the further next 2-3 years looks very enterprising. And as far as this H2 is concerned, H1 was badly hit first quarter because of the elections and the heat wave, and in second quarter there were a lot of rains in our. However, the numbers were not hit that badly in second Q2 because of the rain. But believe me, this quarter is good. And it is not only good for us, it is for the entire industry. And we have been doing predominantly very well in this quarter, and hopefully fourth quarter also appears to be very good.
So, Jaiswal, that you have a lot of new inventory coming up. In fact, you've mentioned that you have stayed in front of the curve in terms of the capacity additions that you plan over the next 2 to 3 years. But considering the kind of capex that you're making with the new inventory coming on stream, I want to understand the margin picture for not this FY25 in particular, but once the inventory is back full-fledged in picture, we see more of these revenue growth that you've pointed out after 2 to 3 years. So long-term picture in terms of where margins are concerned, if you can give us clarification that whether it would be back to what we had seen in the FY23 levels or where?
See, let me tell you, we don't have a huge capex plan. Okay, as I told you earlier also that our strategy is asset light, and these hotels which are coming up, you know, a lot of other revenue share hotels are coming up where we don't have a huge capex deployment. In management business, we don't invest anything, and only in the revenue share, some part of capex is required for the deposit and all. But we don't have a huge capex plan. Barring couple of hotels, one is Goa, where we are trying to add another 40 odd rooms. So there probably we'll be spending some 25 crores for adding those, because Goa market is doing phenomenal, and that hotel will add a lot of value to our the entire group. And apart from that, another 15 crore, we are again adding inventory in our resort in Bangalore, which is also doing very well. So barring this, we don't have a huge capex plan. We are committed to follow the asset light strategy, which we will be doing. So our return on capital employment is going to further improve in next couple of years.
So, Mr. Jaiswal, you've guided for 100 crore profit after tax by FY26. You're guiding for a 500 crore top line by FY26. Mumbai hotel also coming through likely. Where do you deploy that money? Because you're going to be capex light.
Yeah, so yes, I will explain to you. See, these internal accruals, we will try to make the company debt free.
Okay.
Second, whatever revenue share hotels we sign, we need to give some deposit, like 6 months rental deposit, and some working capital and some loose furniture, linen, blah blah things we have to add. So for each hotel, say of 100 rooms, we need to invest around 8 to 9 crores. So with this money, we will be further growing and taking the hotels on leases and revenue share model in time to come. The target is that around 10% of the addition should come in this, leased and revenue share model.
So just give us visibility. Maybe FY26, how many hotels will you have? How many would you be owning and how many will you be managing?
See, if you really look at that, how we are owning and managing, see, most of our hotel are managed. See, total 6,556 rooms, out of which 5,277 rooms we are managing. And balance, we are owning and leasing it. So this ratio we will be maintaining. And in FY26, we should be owning roughly around 130 odd hotels by the end of FY26, 130 to 135 hotels. We will be running it, out of which around 18 hotels we will be, like owned and leased model, it will be there. Balance all we will be managing it.
Thank you so much for joining us and giving us all of those clarifications. Helpful to understand how the business is doing. Thanks so much for joining us this morning.
Thank you, yes, thanks.
Well, with that, from Anushi, myself, everyone who puts the show together, thanks so much for watching. We hope you found it extremely productive. Stay tuned to NDTV Profit, more action on the other side.